This video is the fifth of a series of 6 related to project management. We are now addressing the topic of the economic viability of the project, and in this presentation we will talk about criteria that can be used to accept or reject a project. This presentation is organized in 2 parts. In the first part we present the criteria, namely the net present value, the payback period, and the internal rate of return. We will conclude this part with a detailed example of the application of the NPV criterion. In the second part, we present a review of the main financial maps which are important for this subject, namely the balance sheet and the income statement. To illustrate the main interactions between these two pieces of information, we then present a simple practical example. We are going to analyze first the net present value criteria. Now, it involves the evaluation of the present value of the future cash flows that will be generated by the project during the life of the project, and then subtracting the initial investment. If the net present value is greater than 0, we say that the project is economically viable. Well, it's a criteria that can be stated very simply. Nevertheless, it's not easy to apply in practice because it involves making predictions about the future cash flows of the project and also predictions or estimations about the opportunity cost of capital, which is obtained from the profitability of similar projects that are available in the market. To obtain the predictions about the future cash flows, we can make predictions about the activity of the company, and with that we can make predictions about the financial maps, and in particular about the income statement for each year of the life of the project. But after obtaining those predictions, we need to take care about some details. Essentially, two aspects that are different when we build the income statement and when we need to evaluate the cash flow statement. So the first one is related with depreciation. Depreciation is not a cash flow. Nevertheless, depreciation has impact on the taxes that the company have to pay. So we should exclude depreciation, but we cannot exclude the effect on taxes that the depreciation originates. The other aspect is related with the debt that the company may need, but because the viability of the project should not depend on the way the project is financed, we should exclude the tax effects of debt in the cash flow. So to illustrate these two aspects, we have here a very simple example. So we have here on the left, we have an example of an income statement for a given year, in which we have here the main accounts related with the income statement. We start with sales. We subtract the cost of sales, then we subtract depreciation, and we obtain what we call the earnings before interest and taxes, which in this case is 20 units. We assume that there is a loan and we have to pay interest on that loan in the amount of minus 10 units. Subtracting the interest, we obtain what is the earnings before taxes. So if this quantity is positive, we have to pay taxes, which we assume that in this example the tax rate is 30%. So we have to pay 3 units. So, and subtracting the taxes, we obtain the net income. Now, we can build the cash flow for this year using this information, but taking care of these aspects. So we start by considering here also the depreciation, but now what we obtain here the same number, but we call this the earnings before taxes, because we are not going to consider the interest. We should evaluate the cash flow, assuming that the company has no debt. Okay, so if the tax rate is 30%, now we evaluate 30% of this value now. So the tax that we have to pay in this case, if we exclude the interest, is higher. Okay. Then we obtain what is called the earnings after taxes. Well, we include here depreciation. I'm sorry, we subtract here depreciation. Now, because we want to account for the tax effect of the depreciation. But since depreciation is not a cash flow, we add them back here. Okay, so the cash flow is the earnings after taxes, adding the depreciation. So in this case, the cash flow is 24 units. Now, in the previous example, we illustrate how we can obtain the operating cash flow. That is, the information that we have here is related with the operations of the company. So what we have here in the end in this process is what we call the operating cash flow. But in practice, what we should use is what is called the free cash flow. And with this example, I'm going to try to explain why there is a difference. What we have here is the predictions for 3 operating cash flows for year 1, 2, and 3. They are equal for simplicity. Okay. And what we have here in blue and red are cash flows that, in fact, they cancel. So this is the blue is a positive cash flow and the red is a negative cash flow. And what they represent, what we intend to represent with this, is that we may have to pay before we receive. So payment period may be less than the receiving period on average. So this means that to face this payment, I need to save part of this cash flow. I cannot use it. I cannot discount it. I need to save part of this cash flow to be able to pay this cash flow, because I cannot pay it with this part here. Okay. And this is what we do in this figure. So we just make a redistribution of the money. So here, instead of using or instead of discounting 100, I must discount 100 less 20, which I consider here. And this part here is moved there. Okay, so I move part from here, and I do the same here. So to be able to pay this amount here, I move part. So I move this one there, and part goes there. Okay. So what I have available now here is 80. Here I have 90, and here I have 130. This is the free cash flow. Okay. So we are going to illustrate next how we can calculate this. In this table, we illustrate the calculation of the free cash flow. So the part of the operating cash flow that we need to save to be able to pay those accounts that we illustrate in the example in red is called the working capital. So we need to save here. We need to save 20. So this is the working capital for time 1, and we need to save here 30. So this is the working capital for year 2, and here in year 3, we didn't need to save anything. So this is what we have here. So the working capital in year 1 is 20, the working capital in year 2 is 30, and 0. Okay. Now we evaluate the free cash flow from the operating cash flow, subtracting the variation of the working capital. So the variation of working capital here is 20 less 0, which is 20. Now 30 less 20, which is 10. And now 0 less 30, which is minus 30. And so we have here the operating cash flow in the last line, and the cash flow is subtracting to the operating cash flow the variation of the working capital. So here is 0. So here is 100 less 20, that is 80. Here 100 less 10, that is 90. And here 100 less minus 30, that is 130. So of course that we just made a redistribution, because here when we have 300 units, and here on the free cash flow we have also 300 units when we add them. Okay, so what we need to consider is simply a different distribution. The second criteria that we are going to analyze is the payback period. The payback period is the point in time in which the accumulation of cash flows becomes higher or equal to the investment. To illustrate this criteria, we have here an example of three projects, project A, B, and C, with different lives. Project A has a life of 2 years, and B and C have a life of 3 years. We are going to evaluate also the net present value of these projects, assuming that the opportunity cost of capital is 10%. And we do this because many investors take decisions based essentially on the payback period. And the intention here is to show that there is no rationality on that. So a project with a lower payback period may be a bad project, and the project with the highest payback period may in fact be the best project. This is what we have here in this example. So, for example, we have here the project A. In project A, the investment is 2,000 euros. Well, it's the same in the three projects, but project A originates after 1 year a cash flow that is equal or higher than the initial investment. So the payback period in this case is 1 year. But when we evaluate the net present value, that is, when we evaluate the present value of C1, the present value of C2, and then we subtract the initial investment, we get a value that is less than 0. So according to the net present value criteria, this project is not economically viable. This is not the same to say that it will not generate a profit. It will generate a profit, but not enough to compensate this opportunity cost of capital. This is what we are saying. When we consider project B, we need to go up to here, up to time equal 2, so that these two, when we add them, are higher or equal than the original investment. So the payback period now is 2 years. Well, this is an economical viable project. And when we go to project 3, so the investment is the same, but now we need these 3 so that the sum of these 3 is higher or equal than this one. So payback period is 3 years, so it's the highest. Nevertheless, this is the best project because it has the highest net present value. And the third criteria is the criteria of the internal rate of return. Well, the internal rate of return is defined as the discount rate R, which makes the net present value equal to 0, as we state here, or we can represent in this way. So instead of using the opportunity cost of capital, we consider here the internal rate of return and solve. We solve to evaluate the internal rate of return so that we make the net present value equal to 0. And of course, if the internal rate of return is higher than the opportunity cost of capital, we conclude that this project reward us at a higher rate, and that implies that the net present value is greater than 0. So this is a good criterion when we don't have enough information related with the opportunity cost of capital. So if we arrive to an internal rate of return that is high comparing to typical projects, we tend to consider that this should be a good project. The problem is that the net present value sometimes is not a well-behaved function of the discount rate. Okay, so we have here an example of investment with a life of 3 years. We evaluate for this project net present value, assuming that opportunity cost of capital is 10%, and we determine the internal rate of return. So the internal rate of return is this point here in this graphic. So this is the opportunity cost of capital, and we have here the net present value. As we can see, this line here is a well-behaved function with the discount rate, and it is a well-behaved function because the cash flows here are they don't change sign, so all of them are positive. And when we have this situation, which in fact is very frequent, we can in fact conclude as we say here. So internal rate of return is higher than the opportunity cost of capital, so net present value in this point, of course, should be greater than 0. Nevertheless, the criteria of the internal rate of return not always is a good one also. And to illustrate that, we have this example. And in this example, we have a project that starts with a positive cash flow and ends with a negative cash flow. The duration of the project is 3 years. So these kind of situations may occur when we start by selling something in a project, for example, that is the conversion of old factory, and then we have the main investment in the end of the next year, and then in the end of the life of the project, we may have expenses or costs related with dismantling of the factory. So we have here a project which starts with a positive cash flow, then we have a negative cash flow, then a positive, and then a negative one. If we try to evaluate internal rate of return of this project is 20%. And if we evaluate the net present value considering an opportunity cost of capital, it's a negative value. We obtain a negative value. So the evolution of the net present value relatively to the discount rate R is represented here in this line in blue. So we have here the points for the opportunity cost of capital, so a negative net present value, and we can see that we have positive net present values here on the right. We in this case, the relation between the internal rate of return and the opportunity cost of capital is the inverse of the previous example. So when the discount rate is lower than the internal rate of return, we obtain a negative net present value. So, and the opposite is also the same. So when the discount rate is higher than the internal rate of return, we get a net present value. So we cannot use the same conclusion as before. So here we conclude that if the opportunity cost of capital is lower than the internal rate of return, the project is good. Here the conclusion is the opposite. If it is lower than the internal rate of return, the project is not good. And when we try to use this criteria, the criteria of the internal rate of return, we may also find other situations like the one that we illustrate with this example. So this is just an example built for obtaining, of course, this solution to illustrate what can happen in fact. The project has two years. It starts with an investment of 1,000 euros. Then it will produce a cash flow of 6,250 euros, and then we will have this expense in the end, in time 2. When we try to find the internal rate of return, in this case, there are two solutions. One is 25%, and the other one is 4, that is 400%. When we try to evaluate net present value of this project, assuming that the opportunity cost of capital is 10, this is a bad project for this opportunity cost of capital. But when we represent the net present value as a function of the discount rate, we can in fact find here the 2 points in which the net present value is 0, correspond to what we have here, but we can see that in this range, the project has a positive net present value. Of course, here for the 10% is negative, so the 10% is more or less here. Okay, so the conclusion is that in fact we must be careful with the criteria of the internal rate of return. In practice, in most of the projects have cash flows that are well behaved. But when that is not the case, that is when we have changes in sign. So we have here a negative, then we have a positive, then a negative, and so on. We may face complex situations, and we cannot decide based on this criteria. Now we are going to work with an example that allow us to illustrate the steps and some details involved with the application of the net present value criteria. So we have a project with a life of 6 years. This may be a project to build some factory, for example, and in the end of we need 3 months to dismantle the factory. So we have information related with the investment, and here in this table we have information related with the predictions of sales, the cost of sales. We have other costs, and we have information related with the taxes. So here we reproduce the steps involved in building the income statement. Okay, let's look to the information that we have here on top. We have here that the initial investment in assets is 10 million euros. These assets are assets that can be depreciated. So we have here information about the life of project N, and E stands for the economical life of the assets. These two, in this example, these two parameters are equal, but this is not always the case. The economical life is the period of time in which we can depreciate the assets, while N, it's the physical life, which may be different from the economical life. Okay. We have also here two values for the residual value of assets. One is what is known as the accounting residual value. This is decided for us with the agreement of the tax authorities, and it's used to evaluate the depreciation of assets that we do every year. Okay, while the market residual value is a prediction of how much we will be able to sell those assets in the end. Okay, so this may be different. The definition of depreciation is presented here with this expression. So we subtract to the initial value of assets the final accounting value, and then we divide the result by 6. So we subtract these two values, the investment and the residual accounting, as we show here, and we divide by 6, and we get this amount, 1.583 million euros. Okay. Now let's look to the information that we have here on the table on the first three lines. So we have here in line 1 a negative value corresponding to the initial investment, minus 10 million euros. So the values here are representing thousands of euros. And in the end, we have the residual market value, so this value here. Okay. Now, the second line represents the book value of assets. So the book value of assets initially, of course, it's equal to this value, 10 million euros. Okay, and then we subtract year by year the depreciation. So we start with 10,000, then we have 8,000, and so on, up to times 6, in which we have the residual accounting value, the 500,000 or half a million. Okay, which of course this is the book value that will be available also in the time of dismantling the company. Now we have also in line 3 information related with the working capital. So here in time 0 we don't need working capital, but we start after year 1 and we terminate in year 6 with this amount of necessary working capital. Then we have information related with the predictions of the operating conditions of the company. So we start with sales in line 4. We start also with the cost of the goods sold, or the cost of sales. Okay, which start also in line 1 and go through line 6. We have information related with other costs in line 6. Okay. This may be other investments that we need to make, but these investments are not in physical assets, so they are not they cannot be depreciated. Okay, so but we have also other costs during the life of the project. Okay, now we list here the depreciation because we need to list it here because we consider it a cost for tax purposes, but then of course we will need to put it back because it's not a cash flow. This is not a cash flow. Okay. Now with this information, as we saw before, we can evaluate what we call the earnings before taxes. So we start with line 4 and then we subtract line 5, 6, and 7. And we get here a negative value in time 0, another one in time 1, and the rest are positive. Here we subtract these two, okay? These two, because this difference is considered a profit, so this difference must pay taxes, okay? So the earning before taxes, when positive, must pay taxes. Well, but we have here these negative values, and we calculated also what is the meaning of this. So we are assuming that this project belongs to a company which has other projects that are running. So they have profits in this year. So this will reduce those profits. So will reduce the tax they will pay. So this is a negative tax here represents a saving in taxes in other projects. That's why we build it here. we present it here. And we evaluate taxes, of course, assuming a tax rate, which in this case is 34%. So line number 9 is just obtained from line number 8, multiplying by this rate. Okay, and then we have the earnings after taxes. We just need to subtract line 9 from line 8, and we obtain these results. Okay. Now, in this table, we illustrate the calculation of the free cash flow. We have here in the first line the information that we had in previous table about the working capital in each of the years. So we know that the free cash flow is related with the operating cash flow, subtracting the variation of the working capital. So what we have here is the variation of the working capital. So 550 less 0 is 550, and so on. Here we have 1,289 less 550, we get this result, and so on. Okay, so in the end we have 0 less 2002, that is minus 2002. Now we also have here the earnings after taxes. So this part here, the earnings after tax and the depreciation, is the operating cash flow. Okay, so we need to add these two and subtract the variation of the working capital to obtain the free cash flow. Okay, now we do this for the 6 years of operation and also for this last point in time in which we conclude the dismantling of the factory. Well, we just need now to consider, let's go back to see. So we have here the investment. The initial investment is this amount, okay, and this amount, okay, which we have here, okay, which we have here. And then we have the present value of the cash flow. So the first one, so we consider here the opportunity cost of capital is 20%. So this is for the first one. This is for the second, and so on. And this is for the last year of operation. And this is this point in time in which we conclude the dismantling of the company. So we obtain a positive value. So it's greater than 0. It's economically viable, this project. And now we move on to the second topic, financial maps. So let's start with the balance sheet. This is a document in which we have information related with the equity and the financial situation of a company in a given point in time. And there are 3 main groups of information. Information related with assets, information related with liabilities, and information related with the equity. Assets are the goods that the company controls or uses to produce its goods or services, and liabilities and equity stand for how these assets were financed. Essentially, we can finance the assets through debt, for example, loans from banks, and other kind of loans, as we will explain later. And then there are also the money that was introduced in the company from its owners, the stockholders of the company. Now let's look in more detail to assets. So we have 2 kinds of assets: what we call current assets and fixed assets. In current assets, we have essentially cash, that is money that is available in a bank account, for example. we have accounts receivable. This stands for the money that we didn't receive yet from goods or service that we already sold. And we have, for example, inventories. Inventories stand for example, for raw material or for goods that were produced and were not yet sold. And in fixed assets, we have, for example, property and land and equipment. The equipment that is used to produce the goods that we sold, and property and land stands for factories, for example, and land in which the buildings of the company are installed. So in terms of liabilities, we can also distinguish two types of liabilities. We have current liabilities or short-term liabilities, and we have also long-term liabilities. In current liabilities, we have accounts payable. This can stand, for example, for raw material that we bought, that we already received, but we didn't pay it yet. But we have to pay, for example, in a month from today. We have bank loans. So bank loans, we have two possibilities. We have bank loans here in the current liabilities, but we can also have bank loans here in long-term liabilities. Here we have those ones that we may pay this year. In bank loans classified as long-term liabilities are bank loans that we have to pay in more than 1 year, 5, 10, whatever. Okay. We may have also other creditors. For example, when we have to pay taxes to the state, we already recognize that debt, but we didn't pay it yet. That money. So we have a debt that must be paid by the end of the year. So we can have that information here. Okay. And another important source of debt is the issued debt securities. That is, a company, instead of going to a bank and ask for a loan, they can sell titles of debt to the general public. So the public, a person, for example, can buy these titles. They are called bonds. And when we buy a bond, what we receive is a title. So we pay for that 1,000 euros, for example. So the company receives this money and uses this money. And then it compensates us for that money that we paid for the bond. In general, it gives interest once a year or 2 times a year. And after a while, for example, 10 years, we receive our original money. Okay, so this is the part of the debt that we use to finance part of the assets that we have here. But we have another source of financing is through equity. Equity is the money that was put in the company through its creators, its founders, what we call the stockholders. So they are the owners of the company. And there are these important points to look here. Is the capital. The capital is the original amount that each owner introduced in the company. So reserves is part of the profit that is generated, and it stays there for some special events. For example, like some problem in the company that was not expected, so they have money to face those problems, like a fire, like an earthquake, something like that. So this is money that is reserved for unpredictable factors. And it comes it is generated from the profits of the company. We have also what is called retained earnings. return earnings. So in the end of a year, a profit is evaluated, and that profit then will be distributed part to reserves, part will be retained here in return earnings for future investments, for example, to buy new equipment, to buy new land, a new factory, whatever. Okay, and we have also what is called the net income. So this is the profit that is generated during a year. So it appears in the balance sheet when the balance sheet is obtained in the end of a year. Okay, so these are the main information that is relevant for us here in project management. So here in the end we have what is called the fundamental equation of the balance sheet. So essentially this equation states that what we have here in assets, that is this part here, is equal to what we have here on the right side. That is, the part of debt is the part related with the liabilities, and the part of the equity is related with the capital of the shareholders. So everything is registered at what we call the book value, that is the accounting value. And so we have here essentially the goods of the company, and we have here how these goods were financed, part with debt or liabilities, and part with the shareholders' money. The other important financial map is the income statement. So the income statement is a document in which it is shown how the company generates the results for a given year, that is the net income. Essentially, the net income is the difference between revenues and costs. Nevertheless, that information is classified according, for example, to the kind of revenues or costs that are generated. So we distinguish essentially the three types of results. The results there that are related with the operation of the company, that is, we call it the operating results. We have also results that can come from financial investments. So the company, when they have too much money and they have no projects in which to invest, so they can put their money in financial investments. And there are also what we call the extraordinary results. This can be, of course, positive or negative. For example, when they sell an old factory, and if they make a profit on those on that, it's registered here. Or, for example, if they suffer a fire or any other disaster, it can also be registered here. Okay, so let's start with the operating result. In the operating result, we start with the revenues from the sales and other operating revenues. For example, we sell goods, but we also sell service related, for example, with the repair of those goods. Okay, so this is where we start the income statement with the revenues from our operations. Then we have the costs. The costs related with these revenues. We call it cost of sales, of cost of goods sold. We may have also other operating costs, like, for example, the cleaning of the factory and the maintenance of machinery. We also have what is known as the depreciation of the machinery involved in the production of these goods. Okay. Now then, with these items we obtained operating result. We add to the operating result the result from financial investments, result from extraordinary results, and we obtain what is called the earnings before interest and taxes, because we may have to pay interest from loans that we ask to banks for buying equipment, for example, or for buying a building or whatever. So we may have to pay interest to the banks. It's registered here. After that, we have what is called earnings before taxes. Okay, earnings before taxes. And taxes, we must pay taxes. If this is greater than 0, we must pay taxes to the state. And for example, at a 20% rate or something like that. Okay, so when we subtract taxes, we get the net income. Okay, so this is what is important about the income statement. Then we are going to analyze a case study in which we are going to link these two maps, that is the balance sheet and income statement. There is some dynamics that we can illustrate only with an example. So let's look to our study example. It's a very simple situation in which a company was formed in the beginning, for example, of the last year, and by two partners. Each partner entered with a capital of 2,500 euros. That is, there are two shares. And the business of this company is a very simple one. They just buy clothing to some factory and they sell that clothing to the general public or to other sellers. To operate this business, they need to buy a vehicle to transport the goods, and they decide to buy that the vehicle when they start the business, that is in t equals 0, and the cost of the car was 10,000 euros. Of course, they don't at the beginning they didn't have that money, so they asked for a loan to a bank. So they have 5,000 and they ask 5,000 to a bank, and this loan has a cost which is 10%. But they get a special agreement with the bank, that is, they don't need to repay the loan at a fixed time or a fixed date. So in the first year, for example, they just need to pay the interest, same for the second, and so on. So they have that kind of agreement. They pay back the loan when they decide. Meanwhile, they have to pay to the bank the interest, that is the cost of having the money with them. Okay, so what is important for us also related with this vehicle is that they consider that this vehicle will have an economic life of 5 years. This is defined according to the authorities. There is some flexibility. It can be, for example, 3 years, but it can go to 10 years. Well, they decided 5. They decided 5 years. Now, with this information, we are able to build the balance sheet just a few days before the company was formed. Well, we don't have any cash because we spend everything in buying the vehicle. So we have in fixed assets, we have 10,000 euros. Now, on the right, we have in liabilities the value of the bank loan, that is the 5,000 euros. And in the equity, we have in capital also 5,000 euros. So we don't have yet reserves, and we don't have anything also, nothing in net income. Now, what we saw before, so we have here the fundamental equation of the balance sheet, and as we can see, it is verified in time zero. That is, we have in assets 10,000, we have in debt 5,000, and we have in equity 5,000. We consider now that 1 year already passed, and our objective at this point is to evaluate the performance of our company. So we need to evaluate the net income, that is the profit, and also to restate the balance sheet. We have the following information, which is listed in these four points. So we have data related with the sales. So we can see here that the sales were 5,000 euros. And then the costs related with these sales is 1,000 euros. We are allowed for tax purposes to include the depreciation of the vehicle as a cost of the products, because the vehicle is being consumed to make possible the sales. So to make possible the sales, we must buy the product, but we also need to distribute the product, and we need the vehicle for that. So it's a cost of the product. We also need to consider the payment of interest related with the loan. So we agreed initially that we are not going to amortize the vehicle, but we have to pay the interest because we are using the money of the bank. So the bank needs to receive his reward. And in the end, if there is a profit, that is, if the revenues are greater than the costs, we will have to pay taxes to the tax authorities in the amount of 20% of the profits. Now, we are going to build first the income statement, and to do that, we need to evaluate first the depreciation of the vehicle. So the depreciation of the vehicle is evaluated by this expression that we have here. It involves the economical life, which we agreed with the financial authorities that it would be 5 years, but we need also to agree about this value here, the residual value, which we are saying now that it was agreed to be zero. Okay, it can be any value. It must be proposed to the financial authorities, and they agree or not. Okay, so but this is a typical assumption. Okay, so the depreciation is under these circumstances equal to this value that we have here, that is the original investment in the vehicle divided by the economical life. So we get this value of 2,000 euros per year. So this is a cost of the product, because the vehicle is being used to make possible the sales. So we need to buy the products, and then we need to sell them, and we need the vehicle to sell the products. So this is a cost, is seen as a cost of the products. It's the consumption of the vehicle. So the vehicle will be consumed. So the meaning of depreciation is exactly that. The vehicle will be consumed during 5 years. And this is the consumption of the first year. Okay. Now we need also to evaluate the interest that we need to pay to the bank. Okay, because we have to pay. Otherwise, they will come and get the vehicle, and the company will be terminated. Okay, so the interest, which we represent as J, is of course equal to the debt, our debt, which is the bank loan. We are assuming that we are not refund the banking for nothing. So we just paid interest to them, so we are not repaying the debt. So the interest is the bank loan multiplied by the interest rate. That is, the bank loan is 5,000, the interest rate is 10%. So this is the amount of interest that we have to pay to the bank for the first year. Now we can evaluate directly the earnings before taxes, because we already know the amount of sales. We already evaluate the total costs involved. That is the cost of the goods sold, which were 1,000 euros. We evaluate also the depreciation of the vehicle, and also we evaluated the interest that we must pay to the bank. So in our example, the earnings before taxes can be evaluated as simply subtracting to the sales, which were 5,000, the cost of the goods sold, the depreciation, and the interest paid to the bank. And this is the earnings before tax, 1,500 euros. Now we need to pay tax on this amount because this amount is greater than zero. Okay, so and what we must pay is this fraction, 20%. Okay, so in this case is 300 euros. So what's left for us is the difference, 1,200 euros. So this is the net income that was generated in the first year of operation. And this is how we are going to present the income statement. So with the information that we obtained previously, we can say that the income statement in time equal 1, starts with the sales. We subtract the cost of the goods sold, we subtract the depreciation, so we obtain the operating result. So we have no other results, so we obtain the earnings before interest and taxes, and then we subtract the interest paid to the bank, and we obtain the earnings before taxes, which is 1,500 euros. Then we subtract the tax, which is 20% of this amount, and we get the net income as we saw before. Now we want to rebuild the balance sheet at time equal 1. And to do that, we need the previous balance sheet, that is the balance sheet in time equal 0, then the income statement that was built in time equal 1. So we need to reevaluate each account of the balance sheet. Let's start, for example, with cash. So originally cash is 0. Now what will be cash in time equal 1, which we represent here? So what is important in this calculation is to notice that depreciation does not involve cash. Okay, it's just an accounting number. It's here because in fact the tax authorities allow us to consider it here, and the effect is essentially reducing this amount here, the earnings before taxes, because you are subtracting this to the sales. So the earnings before taxes is lower, so the tax is lower, and of course the net income is also lower, but it's not cash involved. Okay, so what is the cash involved here in the net income? So we can highlight it. For example, we receive this amount, we paid this amount, we pay this amount, the interest, and we pay these taxes. So the cash involved are those terms that are listed there, which we list here. So we receive this from sales, we pay this from the cost of the goods sold, we pay this on interest in the bank, and we pay this to the tax authorities. So this will be the amount that will be available in cash after 1 year. Okay. Now, so the next is fixed assets. Well, in fixed assets initially we have this number, but this is just a number. This is a book number, something that is registered because we bought the vehicle by this amount, and in time equal 0 we assume that this is the value of the vehicle. After 1 year we assume that the value of the vehicle is this original one, less the depreciation. Okay, this is what we are doing here. So the original amount less the depreciation, and now it will be 8,000 euros. But again, this is just a book value, okay, which is evaluated according to the tax regulations. Okay. Now, in the bank loan, we are not going to repay anything. We just pay for the using of the money, which is the interest that is here. Okay, the interest is here. Okay, we are not amortize the bank loan. Okay, so here in capital, we are not going also to increase capital. We are not going to put more money there. Okay, and we cannot extract the money that we put there. Okay, so this is this will not change. So what will change also is, of course, here the net income. So we will see what's happening next. Now, with the information that we obtained previously, we can build the balance sheet in time equal 1. For example, we can see here that now in cash we have the amount that we evaluate previously, that is 3,200 euros. In fixed assets, again, we subtract to the previous value the depreciation. Now we have 8,000 euros, and then in total assets, we have 11,200 euros. Okay. Now, going here to the right side, we see that in liabilities there is no change, so the bank loan is the same. Now, in the equity, this part remains the same because we didn't put more money in the company. We don't have yet reserves, and now we have here the net income. So we can say here that the debt now is equal to the previous debt. We can say here that the new equity is the previous equity plus the net income, and we can say the same here in terms of the assets. So the new assets is the previous assets plus the net income. As we can see, we have here 11,200, which is equal to 10,000 plus the net income, that is 1,200 euros. Okay, so the balance sheet fundamental equation is verified because we have here the assets, which is equal to the debt. The new assets are equal to the new debt plus the new equity, but we also have these two relations. That is, the new value of assets is the previous one plus the net income, and the new value of equity is the previous value and the net income. With the information that we have now available in the balance sheet for time equal 1, we may want to reevaluate the value of the shares. This is important because as investors, we may want to quit our participation in this business, and that should not mean the killing of the business, because other investors may be interested in occupy our position and working in the area in which the company was created. So essentially, we can define three types or three kinds of values for the shares. One is what is called the nominal value. So the nominal value is evaluated, taking in account this part here, the capital of the company, and the number of shares. So in our case, we have no changes here at this point in time. So a number of shares, as we saw before, was 2. So this part remains the same. Okay. The other possibility is to define what is the book value. The book value involves this part, all of this. So involves the equity. So the book value involves the equity, and the equity is divided by the number of shares. So in this case, we have a greater amount, 3,100 euros. So this is the value that we could obtain if we decide to terminate the company and pay all the debts and then distribute the amount of money for the shareholders. So in this case, we have this cash. We can sell these assets, and then we have to pay this amount. And after that, this is the remaining money. Okay, but the most important, in fact, is the market value. Okay, and in general, if the economical conditions are positive, the market value can be much higher than this value here, the book value. Okay, because it incorporates also information about the possible profits that the company can earn in the future. Of course, that in recession conditions, it's the opposite. We can observe situations in which the market value is lower than the book value. Now, with the information available, that is the information that we get in the end of the year and the information in the beginning of the year, we can calculate what is known as profitability ratios. And one important ratio is the return on assets. So return on assets is simply the variation of total assets divided by the initial value of the total assets. We saw that this variation was equal to the net income. So we get this value, 1,200 euros, divided by the initial assets, which were 10,000 euros. So we get 12%. So this is a measure of the ability of those assets generate wealth. We have also the return on equity. Return on equity has a similar definition, but involves the values of the equity. That is the variation of the equity divided by the initial equity. We saw also that the variation of equity was equal to the net income. So in this case, we obtain 24%, is the double. So this does not measure the ability of creating wealth, but in fact it measures how the health of the shareholders increases. Okay. Now we have another important ratio, which is called the debt ratio. So the debt ratio is simply the amount of debt, total debt, or total liabilities divided by total assets. And in this case, we have a value in the beginning when the company was started. It was 50% because we as shareholders entered with 5,000 euros and we get also debt through the bank loan, which was also 5,000 euros. So at the beginning it was 50%. But now in the end, since debt remains the same and assets now increased, we get a lower value of the debt ratio. Now we are going to analyze the influence of debt in the capital structure. So we start with the debt of 50%. So we can measure the amount of debt through the debt ratio. So the debt ratio was 50%. Now let's analyze what's happening if we change the debt ratio to 75%. So in that case, since the assets are the same, so we just bought the vehicle, which was 10,000 euros, if the debt ratio is 75%, that means that we ask for a loan of 7,500 euros, and we, as shareholders, put half of the money there, only 2,500 euros. Okay? Now, the result, the implications of this change start with the net income. So we can reevaluate the net income through this expression, because the earnings before interest and taxes is the same. So it has only to do with the operating conditions. So we just assume that we buy the same clothing and we sell and in the same conditions. But now the interest is higher, because it is 10% of this. That is 750 euros. Okay. Now this term here stands for the taxes. So this is the we subtract to 1 the tax rate. That is, we keep 80% of this term here. So we multiply by 0.8. So this means that the net income is reduced. Instead of 1,200 euros, the net income is now only 1,000 euros. So this is the first impact. It has costs, so the increasing debt increases the costs, so decreases the result, the final result. Okay. Now let's look to the probability ratios. In terms of return on assets, of course, that we get less now. So we are able to generate less health because we increase the costs. So instead of 12%, we have now only 10%. But in terms of return on equity, we have almost the double, because although the net income is lower, the equity that was used is half. So instead of the value was 24%, we now have 40%. So this means that the shareholders are tempted to use debt, because for them it seems that is better. Okay, but in fact there is a problem with this conclusion, is that in fact we are increasing the expected reward, but we are increasing the risk of the company. If we increase the debt too much, and if we are not able to sell enough to cover these fixed costs, the company may be bankruptcy. But we already saw this kind of relation. So to higher rewards in general, we have associated higher risk. Now we are going to analyze what's happening after the end of 1 year and the beginning of another year. In that change, there is what is called the payment of dividends. So dividends is the only legal way that shareholders can extract money from the company. And a fraction of the net income is paid to the shareholders. In this case, we are going to assume in our example that fraction is 75%. 75% will be given to the shareholders. This fraction is called the payout ratio, and it tends to be more or less constant in companies. So this means that the shareholders, the two partners that decide to build this company, will receive 75% of the net income, and the net income was 1,200 euros, so they will receive 900 euros. The rest of the net income will be registered as reserves. So in this case, what will be registered as reserves is 300 euros. And of course, after this distribution, what will be registered in the account net income will be 0. Okay, so with these operations, there are also changes in the equity, for example. So the equity, the new equity after the payment of dividends, will be the previous one less the amount that was paid. That is, with the original capital and the net income, we had 6,200. Now we are distributing 900 euros. That means that the new equity will be lower than that in the end of the year, but still higher than that of the beginning of the year. So 5,300 euros. Okay. Now, we saw previously that the debt ratio has consequences not only in the reward on assets, but also in the risk of the company. So what's happening in practice is that the companies in a given industry, they tend to have more or less the same debt ratio, and it is more or less stable through time. Okay, so what we are going to do in our example is to assume that for this business that we are analyzing, the right debt ratio is 50%. Okay, so but we saw previously that the debt ratio changes in the end. So in the beginning of the year it was 50%, and in the end of the year it was reduced to 45%. So in order to maintain the debt ratio stable, it means that we need to increase debt. Okay, so we need now more debt. So and the amount of debt that we should ask to the bank it can be evaluated through this expression. So we saw that the debt ratio was equal to the debt divided by assets, but we can also relate the debt ratio with this ratio, the ratio between debt and equity. So it involves this expression here, and in the beginning this ratio was 1. Now, to maintain the debt ratio constant, we require that after the payment of dividends, the debt ratio in the beginning of next year will be also 1. Okay? Now, this means that the new debt should be equal to the new equity, which is here. That means we need to increase our debt by 300 euros. Now, with these results, we can update the balance sheet for the beginning of the next year. So we start with cash. We saw that we have in the end of last year we have this amount in cash, 3,200 euros. Then we distributed 900 euros through dividends. We get a new loan of 300 euros. So what is there in cash for the beginning of next year is 2,600 euros. Okay, so in terms of assets, there is no change from the end of one year to the beginning of the next year. In terms of bank loan, we have an increase of 300 euros. So now we have 5,300 euros due to this new loan. Okay. In terms of equity, the capital, that is the original amount of money that we put in the company, remains the same. We didn't put more money yet. And we have 300 euros registered as reserves. So the new total assets is 10,600 euros, which is equal, of course, to liabilities and equity. And of course, the debt ratio is 0.5 as it was planned. And this is the end of this video. Thank you for watching, and see you on the next video.